Hello everybody, Matt from Just Stack It. And today in this video, I want to talk about the difference between investing in something like silver, precious metals, gold, versus something like real estate. Here on the table are actually the keys to my rental property that I currently have active. So they're very similar in a lot of ways, and they're very different in others. For instance, real estate and silver are both a tangible asset. Tangible assets are assets that we typically like, things that are physical, things that you can hold. Well, sort of. You can't hold a house, but the idea is there. The difference seems to come in when you look at things like liquidity. While a house is arguably a liquid asset, it even more so than silver varies on market conditions, and you're going to be hard pressed to get a quick sale on a house. And if you do, I almost guarantee either the market is well in your favor and you had your pick of the litter, or you're taking a bath on it financially. And it's still going to take a while. There's a lot of paperwork, a lot of inspections, a lot of things to do before somebody purchases a home, a residence, a business, real estate, really of any kind. The upside here is the difference between the investments. This one we hope may go up. We are at the mercy of the markets. This one, we're also at the mercy of the market to a degree, but we can make improvements, we can do things, we can set ourselves up to be in the best position possible for this to rise up in value, where this, we are almost certainly at the mercy of a market that is highly manipulated. The cons of real estate are exactly what you would expect. Upfront costs, buying the property, getting it, raising that kind of capital. Closing costs can be substantial when you go to finally purchase a property. Sometimes you can negotiate some of that away, but not always. Maintenance costs, and this is a big one. Maybe the city's going through and redoing gas lines, and they're going to tear up sidewalks and make you pay for it. Those things happen. You can, again, defer some of those costs, but with something like silver, you don't really have a whole lot of overhead. You have your storage at home or wherever you choose, your safe costs, maybe a home security system if you are so inclined. But there's not a lot of overhead here, but there's not a lot of chance for profit. Over here, there is. The funny thing is that these two classes of people tend to both think very similarly. If you talk to a lot of real estate investors, they don't care what interest rates are. They don't care specifically what the market's doing. If they have money and they're in a good position, they're always going to buy. Where does that sound familiar? That sounds very familiar to most of us stackers who say we're buying no matter what the price is. Another thing is diversification. This is literally the diversification vehicle for most of us, given the fact that you assume a majority of us have some money in stocks and other investments and things. This is our hedge against inflation. This is our safety net. This, at many times, can be a liability. Most people do not enter into real estate lightly, but they enter in cautiously in hopes of large returns. I can't tell you how many stories I've heard as I go around my circles on this side, 25 and 30-year-olds that own more properties than I probably ever will already. Now, maybe their risk tolerance is higher, maybe they're a little more creative. This is more of a community thing. It's more of a quiet thing. This is a rainy day fund for most of us, or, maybe we'll never even see it come to fruition because it's going to get left to family. And that's fine, and that's what a lot of us are planning to do. I know I am in a lot of ways. Maybe not the whole stack, but at least a majority of it is going to get left to my family after I'm gone. But I feel both of these can set you up for success. And if you are doing really good here and you have a lot of liquid, it may not be a bad thing to think about. The only bad thing over here is, what are you going to invest in? You think silver's confusing? This is like division. This is like calculus. It's so complex. There are so many different ways to do it and get the right answer or the right outcome. It's kind of dizzying at times. You can do commercial, you can do residential, you can do multifamily, single family, you can do short-term leases, long-term leases. A lot of people are doing the Airbnb things now, but it's just, how much do you want to put in and how much do you want to get out? And for most of us, we're over in this side of things. We don't want to put in a whole lot of work. We want to buy and acquire and hold and feel safe at night. And that's what this does. This can be a headache. Tenants calling you, issues with rent payments. I mean, there's all kinds of outcomes over here on this side that are less than favorable. But if everything goes well and if you can swing it, the potential for profits over here are far beyond what's available by investing in precious metals. And at the end of the day, even if some of this goes south, you still have that tangible asset that you can liquidate. Again, it will take time. Again, depends on the market, but you can always liquidate this and get a large portion of that money back. You're going to pay, but you're going to get a large portion of it back when you sell, depending on how much appreciation that property may have gone through during the time that you've owned it. I feel there are so many similarities between the two. We just want slightly different outcomes. Somebody who's investing in real estate has unfortunately a more grandiose kind of idea. They're not afraid to put in work and do things to get these things done, to make these things happen in a lot of cases. Over here, this is what I would call more passive investment. This is definitely more active. It's not for everybody. And it's very interesting, as I'm in both of these areas, to look at the similarities between the two, because we all say a lot of similar things. We're all very positive on this side. We don't try to let things get us down. We always think highly of our investments. The same can be said over here. There's a lot of very proud people on this side. They're very happy of their achievements. They're very proud. And again, a lot of these individuals are planning on passing some of these things down to other family members. So we're both building generational wealth, but in different ways. More passive, more active, less initial investment, day to day, much higher initial investment. But if you ever want to consider going to the dark side of investment, I strongly suggest you check out the Bigger Pockets podcast. They're a lot of good people over there. They've been doing it for a very long time. And if you're at all interested, you can go over there. They've done a podcast or talks on just about every aspect of real estate investing. So if you are curious or care to indulge some of your time watching some other content, you can go over there. That's where, I won't say I learned most of what I know there, but I got a lot of great tips and tricks from over there as far as what I do when I actively am seeking real estate. So that's it for me today. I wanted to showcase this because I thought it was very funny, the differences between the two and how they're almost exactly polar opposites, but they just have so many similarities that keep them very tied together. I thought it very interesting. So I wanted to share that with you. I appreciate everyone's time and attention, and I will see you in the next video.